So today on Property Explained, we're going to be discussing how self-employed versus employed in a corporation and the effects of that on your tax obligations. So we're living in a world now where people are really just doing their own thing. The gig economy is growing. People are becoming self-employed either as freelancers or just, starting their own businesses, whatever the case may be. So we need to have serious conversations about how that affects your taxes with regards to property. Joining us for this conversation is Natasha Lord. I hope I'm pronouncing it correctly.
You are. That's
brilliant. You are a tax specialist. Good morning.
Good morning.
Every time I hear the word tax, I get nervous, but
I know.
I'm not going to make it about me.
No, I know. That's my job. Dealing with these nerves. It's all good.
So let's talk about what mistakes we as self-employed individuals make when planning
You're nervous asking that.
when planning to buy property.
Okay. The biggest thing I see is that people don't actually know their tax situation. So they don't actually know which taxes that they're liable for. If you're a freelancer, most people don't even know they're a freelancer and what tax implications those are, because a lot of people are used to just their taxes being taken care of by their employer. But when you move into a freelance space, so you're an influencer, you are even someone who's just receiving passive income, things like that, there are tax implications. And when you're wanting to buy property, now they're looking for certain documentation that people have just not heard of.
Wow.
So it's super, super important to do that. And that leads to planning. So, we think, let me just buy property. But you need to have about 6 months to a year of building up and making sure you're okay. So when it comes to buying a property, you're about 6 months to a year behind what you should be doing. You're compliant. So people just don't know what they're liable for.
So what you're saying is, outside of proving the income that you're getting, you also need to be tax correct.
Exactly.
When you are running your own business or as a freelancer, if you want to buy property.
Exactly. And they're getting a lot more strict on that, because we're seeing people bringing all of these institutions together. So if it's your banking, if it's SARS, they're asking for your IT-34 now. And it's what is that? What is that? It's a declaration of how much tax you've paid. So you can actually say, you can have the bank statement of 50,000 Rand a month. You can have the pay slip of 50,000 Rand a month, but have you been compliant? What is your tax strategy? So maybe your tax is not as much as as the 50,000 Rand, which is about 13,000 Rand.
Yeah.
But you have a different tax strategy that you have in place that's authoritative.
Yeah.
But people don't know that they can plan. You shouldn't get to the end of your tax year and think, well, I don't know. I'm hopeful. I don't know if I'm owing SARS. I don't know if I should be receiving
And why is this important? What does, my property have to do with SARS?
Ooh. So we're citizens of the country.
Yeah. Yeah.
We're citizens of the country, and part of our obligations as citizens, part of our legal requirements as being citizens is to know your taxes. That is a legal requirement, is to be knowledgeable of that. And it's not going away. It's an inevitability. But more than that, I think in our African context, it speaks to legacy. You put your legacy at risk when you're non-compliant. If we're sitting here and we're not having conversations with our children about these things, we put our legacy at risk. Buying a property is a legacy. It's part of your portfolio. It's part of your estate. And so if you're not understanding that, and you're not compliant for 100,000 Rand, and your property gets seized, that's your children's legacy. That's your
true.
legacy. So it's a conversation beyond just being compliant. It's a conversation of how do we change what's happened in our generations, and our parents might have not had that conversation with us because they didn't have those assets. And so it was not needed. But now if we really want to change our bloodline, our destiny, our DNA, and our legacy for our children, we have to have those conversations.
By the way, Natasha, you look absolutely beautiful. Thank you for joining us this morning. And with regards to building our portfolio, building our legacy, what are the differences between self-employed individuals and employed individuals tax-wise? So let's understand that space.
Oh, it's a conversation, but I'll give you a few stark differences.
Sure.
The first one is that employees, their tax happens at tax season. It happens once a year, and their employers take care of their taxes throughout the year. Every month by the 7th, you might not know this, but your employer is paying over that deduction on their SARS profile. So you're fine. With self-employed individuals, the one great thing is that you have a lot of deductions that are available and applicable. So me coming here and I use an Uber, I can deduct that from my taxes if I'm a sole proprietor, I can't do that as an employed individual. I pay on what I earn. I don't pay on what's left over. So self-employed individuals, you're paying on what's left over, especially if you're a sole proprietor, you're doing that. And sole proprietors, I know it sounds jargony, but a lot of people who basically receive income into their personal capacity, into their personal bank account. So you don't have a registered company, but you're freelancing and your income is not set. you are then a freelancer, you're a sole proprietor, and you have Section 11 deductions, which is just amazing for you because you're paying on a reduced amount. But if you don't know that and you take long, SARS is just going to tax you on what you earn as opposed to what's left over.
Yeah, and they don't need an invitation to do that.
They don't need. So, and that's the thing, like, because the finance minister is like, listen, we need more tax money.
Yeah.
Tax makes up for 90% of the state income.
Yeah.
And now we need to collect about R1 billion more in taxes. So there is a huge move, and we've seen it, that there's a huge move for final demands and garnishing of accounts and taking of assets. We've seen seizures and arrests and all of that just because we're not taking care of that.
As we move towards the end of our conversation, Natasha, are there any tax benefits and incentives for buying property as an investment?
Yes. My favorite is a very provocatively named one. It's called Section 13(6). Yep.
Tell us more.
Yeah. So that is basically you have a 10 or 20 year tax write-off, which is amazing at 5% or 10%. A quick one, I can't get into all of the details because of time, but essentially if you had a building cost of about 5 million Rand for those 5 properties, you could write that off at 5% a year, which is about 250,000 Rand per year that you can reduce your taxes by.
Wow.
Yeah. So there are huge incentives for actually developing properties and investing in properties. So instead of buying a 5 million Rand primary residence, you could buy 5 million Rand in investment in properties.
Absolutely. Very important conversation we're having here with Natasha Lord, who's a tax specialist. And of course, this is where buying of property intersects with you being self-employed versus, working for a corporation and all the implications thereof. If anybody would like to get in touch with you or pick your brain further, how do we do this?
So I'm on Instagram, Tax with Tash. I've got my website, which is lordbusiness.solutions, LORDE. And you can get hold of us. You can schedule an appointment with us. You can book a consultation with us, and we can help you with your taxes.
Brilliant. Thank you so much, Your Highness. Natasha Lord, who is a tax specialist, joining us today on the
Thank you
Property
for having
Explained.
me.